Over the Road magazine article, March 2024. Know your business. Being an independent operator is more than driving your own truck. It's about understanding the business model and focusing on what is successful and keeping away from what is not. There are two very different business models in owning your own truck: lease operators and owner operators. The term lease operators has nothing to do with how a truck is financed. It's referring to how a truck is paid. Lease operators get paid cents per mile, loaded or empty. The contracts are as varied as the number of carriers providing the opportunity. Serving the industry for 25 plus years, I've read hundreds of carrier contracts. 25 years ago, carriers didn't even have a fuel subsidy category, never mind a rate. The industry took nearly 10 years to have it a standard entry in their contracts. Even then, the calculations and consistency was anything but stable. As the industry changed, so did contracts. But today, we almost take fuel subsidy for granted. Owner-operators are those who get paid a percentage of the freight invoice. This business model is very different from lease operators. Where lease operators focus on miles, owner-operators consider net rate per mile over time, usually in days. Net rate per mile considers empty miles in calculations. An owner-operator will often wait around for a day or two to be able to pick up a much better paying load, while a lease operator loses money when they are not moving. The two business models are light years apart. Similar to their focus being different, the information they view as their KPIs, or key performance indicators, are also very different. An owner-operator needs to know their gross fuel costs per mile from their income statements provided by their calculations or an accountant. The fuel surcharge added on their freight invoice is irrelevant to the KPIs they focus on. It is all calculated as revenue. Even separating it on their income statement is useless. They have no control over it. They should not track it. Additionally, less than 100% of freight separate fuel surcharge and freight rates, so tracking any portion produces numbers that are useless to managing your truck. Even if you get 100% of all freight invoices displaying fuel surcharges, separating it all would produce no usable information. You would be comparing your fuel costs with something only the carrier negotiates with, a rate that you have no control over. Why track that? So separating freight revenue and fuel surcharge revenue at best is a waste of time. At worst, confusing. However, as a lease operator, putting fuel subsidy as a negative fuel cost alongside your gross fuel cost will produce your net fuel cost, which may be valuable to you. It is something useful in monitoring and comparing carrier contracts. You can track net fuel costs from month to month, showing the ups and downs of costs and subsidy. Does your carrier increase the rates appropriately to provide you a stable net fuel cost? Some do, others don't. I've seen contracts where lease operators would have to get 14 miles to the gallon in order to keep their net fuel cost stable. That's a sucky contract. Comparing contracts using accurate income statement data is just one feature required for success. Probably one of the biggest is non-taxable benefits. That will save you about $12,000 per year in taxes. It may require you to rethink how you do things. But the net benefit is one of the 7 wonders of the Canadian trucking industry. There are several issues important to independent operator success. Me and my team will have a booth at the Truck World 2024 event in Toronto, April 18th to 20th. Come on down, let's talk for a while. Contact our office and we can get you into the show with a free pass. If you can't make it, contact my office. I'd love to talk to you about creating after-tax wealth in your life and career. That was my article, of course, in March 2024. We did go to Truck World. It was a great time there, lots of people, and met a lot of very interested owner-operators. And before I actually went to that truck show, I actually did short interviews on accounting firms all across Canada. I actually interviewed, a short interview, surveyed a little over 400 accounting firms across Canada. There's a lot of information that I actually, not a lot, but a very specific amount of information that I got that was actually quite important, at least to me it was. First of all, 90% of all accountants out there who serve the independent operator industry do not use online accounting software. Maybe 5% push it or present it, and maybe a total of 10 actually do it, and which is all well and good. But I think if you're an independent operator, you have to take a look at your business maybe a little bit differently than historically the people in the industry have. First of all, you're in a high travel industry. Obviously, you're moving. You don't even know where you're going to be sometimes 24 hours from now. At least the freeboard people don't. And you're rarely at the same place every night. And realistically, that fact in and of itself, that means your life or your lifestyle is transitory. You're only home 4, 6, 8 days in a month, or maybe 10, depending on a lot of variables. But you're not home all that much. So where exactly do you want your accountant to be? If the majority of your time is spent in your truck, realistically doing your business of operating your truck, why exactly would your mind say, hey, I have to have a physical location for my accountant? It's nice, it's wonderful if you get home and you can do that. But that's a mindset that people have had in their mind, and it's shouldn't say it's old school. It's 1980s, 1970s mentality, where realistically, when you're at home, you should be doing home things. When you're out on the road, you should be doing business things. So that's why one of the things that we've done here at Making Your Miles Count, the accounting firm, is we have our accounting firm. It would be what you call a it's a first of all, it's paperless, so it's all digital. Everything is done through an app on your phone, and you take pictures, you upload all the documents, then you can go online and see those exact documents that you just finished sending. And so you don't have to keep this bag of paper and then keep it all together and then jump in your car when you are home in your precious time and go and drop it off or have somebody drop it off, that kind of thing. Realistically, having an app on your phone, taking pictures, putting it all up there, seeing it all, you can have your business with you at all times while you're out on the road. And I always look at it that you want to keep your home time special. You want to keep your home time business free. And that means you should probably have your accounting also while you're out on the road. And the only way you could do that is probably digitally through an app. And that's at least how we've set up our business. Yes, we have physical locations, but that's not what we're really promoting. Of course, we serve people at physical locations, but I want to change the mindset of independent operators all across Canada to say, why in the world should I have my home time be filled up with paperwork? Realistically, it should be all done while you're out on the road, and those are habits that should change the mind of an individual when they're an independent operator, that they do the paperwork and they do the business work out on the road. And we've been working on this for an awful long time, almost 8 years now, and there's a lot of great things that we feature. Now, that being said, we also are pretty much I shouldn't say pretty much. We are the only accounting firm in Canada that use non-taxable benefits. There are 1, 2, 3, maybe 3.5 accounting firms out there that do it as well. One of them, I know, I interviewed him in the 400 accounting firms out there. I interviewed them. They're out of Surrey, BC, but they want nothing to do whatsoever with anything digital. Even if you email them paperwork, their staff will print it out first and then do it, and then enter it into the software for accounting purposes. So they're very, very old school. When I talked to him, it was actually kind of funny. He said he will never go paperwork. As soon as it does, then they'll close their doors. As if the whole world goes paperless, he'll close his doors. And not only do they do it not paperless, they also they don't use the full allotted non-taxable benefits that we do. We do it actually. Over twice as much. The dollar figure of non-taxable benefits we use is over twice what they use. They anchor their tax-free non-taxable benefits to a different rate than we do. And we defend it to Canada Revenue Agency. Apparently they do as well. But that means that the average client that we have, anywhere from $35,000 to $42,000 a year, becomes tax-free. So they would have anywhere from $15,000 to maybe $20,000 a year in non-taxable benefits. That makes a huge difference. Our tax savings for our clients are about $12,000 a year, and theirs would only be about $6,000. And realistically, I checked at the price. Our rates that we charge our clients are actually lower than their rates. So, well, that being said, now that was the first one that I found out. There is another one that uses a different number, and they use a number that is higher than our rate. But that particular number, where they have anchored that reference, has to do with the oil industry, and you have to have a specific code in order to use that figure. And if they ever get audited and they don't have that figure, which all long distance guys don't, it's very, very few that actually have that code. It will be reversed. There was a report on CBC reported in 2021, was it? I'd have to check that up again. I'm going by memory here, but and there was thousands and thousands, tens of thousands of dollars that was reversed, and guys were using it as tax deductions, and they just Canada Revenue Agency reversed it. And it is a little bit of a technicality because they had anchored a figure that they couldn't defend in court, and that was the problem. We anchor our figure to a figure that we do defend in court, and we actually guarantee it to $50,000, so that there is no other accounting firm that guarantees it. Never mind these other things yet too. There is another two other. That was the one that does higher than us. There was another one in Ontario that did non-taxable benefits, but they broke the rules. In order to use non-taxable benefits, there are 3 general rules. Number 1, only employees can collect non-taxable benefits. Number 2, you have to have an employer-employee agreement. And number 3, you have to have an audit trail. Now, it's easy to determine whether you're an employee or not. Are you incorporated? If you're incorporated, then that's the first step in you being able to collect non-taxable benefits. The second thing is an employer-employee agreement. Now, that's a little bit more specific, and an auditor will look at that if you are ever audited. And they'll take a look to make sure that the rules of the employer-employee agreement are followed in what's called the audit trail, the third condition. And the audit trail has to do everything from the start would be your ELD logs, the amount that you get paid per day, whether you're in Canada or the United States, and then the year-end balance of that non-taxable benefits, its implications on the on your corporate income tax return, your corporate T2, and then finally that being also exposed in or shown in the filing of your minute books on your corporation. There's a lot of technicalities that are being done, and we've been defending non-taxable benefits to operators now for almost 18 plus years, and the rules that we started with 18 years ago that we defended would not be able to stand right now the way Canada Revenue Agency standards are. I'll tell you, actually the rules 5 or 6 years ago, before COVID, they would not stand today either. We have changed and evolved and got better and better at what we're doing, and their standard seems to just barely, we barely pass sometimes to it. Now we're getting better and better and even faster and faster at it, so I feel quite comfortable with what we're doing, because we have built an entire software infrastructure around the non-taxable benefits for independent operators. And it's been extremely expensive building it, but that's in order for independent operators to phenomenally change their financial future and build after-tax wealth, they gotta use non-taxable benefits. If you're an independent operator and you're not using it, you have to research into it and find out. We have plenty of podcasts on it, and if you want to know more detailed information one-on-one, how it may or may not affect you exactly where you are right now, give me a call and we'll walk you through that process. It's a lot of work to set something up, to change somebody from when they were using the TL2 simplified method, which basically everybody else is doing, and and moving it into non-taxable benefits. Now, the other one in Ontario that was using this the non-taxable benefits, they classified the driver, yourself, as a subcontractor from their own corporation, and that's what disqualified them in there. I have no idea whether that particular accounting firm is even in operation anymore, or whether they're doing non-taxable benefits anymore. It is a very rare thing to get an accounting firm to find you non-taxable benefits or utilize non-taxable benefits. I would be phenomenally interested in hearing about individuals who are using it and are not one of our clients. In 18 years of doing this, like I said, I've actually never had a client that we've taken over from another accounting firm that ever was using non-taxable benefits. Everybody is using the TL2 simplified method. Even when we were in Truck World in April of 2024, I talked to guys, and it takes just 3 or 4 minutes for individuals to find out whether individuals are using it or not. And realistically, bottom line is nobody was using it. And there's a reason for it. And that is accounting firms consider you, independent operators, low-paying freight. They can make way more money in other industries doing accounting and bookkeeping and year-end stuff for other businesses and make way more money than they can on you. At the maximum, they can maybe bill you maybe $2,500, $2,600 in a year, and but they have to put many hours in order to earn that wage for them, and it's just not worth it. Accountants, if they're worth their weight in salt anywhere, they will apply themselves to some different fields like doing year end specializing. They want to bill $500, $800, $1,000 an hour, and they just can't make a living at 800 or I mean 800. They can't make a living at $60, $80 an hour. That's not why they got a degree in accounting, if they even make 60 or 80. That depends on the system that they use, I guess. But that being said, that's pretty much the non-taxable benefit aspect of it. Knowing your business, the difference between lease operator and owner operator, that's our specialization. Taking over clients from other accounting firms, the biggest thing that we've probably realized, number one, is approximately 20% of all balance sheets that come in don't even balance to what's called a Schedule 8 on the income tax form. They don't even balance. We have to do manual adjustments in order to reconcile the two. And that basically means one thing, that the vast majority of people, even if they are from a CPA firm, a CPA isn't doing your paperwork. They've hired somebody off the street to do it, and they pay them, $20, $30 an hour, so that they can charge you $50, $60, $80 an hour, whatever it is, to do that. And so the CPA isn't looking over your tax form. He may glance at it, but generally speaking, it may come, even if you're really lucky, you may be able to have a year-end meeting with him. But he generally delegates that to somebody else. That's what CPA firms do. So realistically, you're low-paying freight, and you have to realize that. I know it sounds like I'm really tooting our horn, but we have well over 550 clients as in our firm, and every single one of them are either lease or owner operators, and we have no intention of doing anything other than lease owner operators for the rest of my career anyway. It's what I have dedicated my life to. It's what I wrote 2 books on. We own 3 books on it. It's why I do podcasts. It's why I do articles. There's only one industry that I'm interested in, and that's independent operator industry. And even though I may not be able to make a whole lot of money, I could probably make a whole lot more money in other industries, but I love this industry. This is what really gets me up in the morning. So understanding the difference, going back to what I was saying, the 2 business models, the lease operators and the owner operators, it's a huge, huge difference. My second book was primarily focused on the lease operators, comparing contracts. The vast majority of operators, a good 15, 20 years ago, were lease operators. Everybody was getting paid cents per mile. Eventually, they got fuel subsidies and stuff like that. And then the real question was, if you have a truck, well, what carrier do you put it on? And the running concern was, or the idea was, they all pay the same. Absolutely not. They do not pay the same. And there's actually the research in my second book using data from 1996 and comparing it to data of 2012. The difference between the lowest paying and the highest paying in 1996, I believe, was $1,800 per month. That's over $20,000 a year in cash flow. And the difference between the lowest paying and the highest paying in 2012 was actually $3,600 or $3,400, something like that. It was almost double of what it was in 1996. So and then the real question, well, if the bottom and the top have grown so far apart, what is the top make even more money? Technically, a little bit, maybe about 10 or 15%, maybe 20% more than the ones in 1996, but it really wasn't all that much. It was maybe it wasn't 20%. I'm going by memory here. But realistically, the bottom fell out the bottom. Bottom fell out the bottom. The lowest paying one was unbelievably low. So in other words, a lot of carriers opened up, and they trolled the industry to see how many guys they could get working for them for next to nothing. I remember back in 1998, 1999, I had a client work for me that after all of his fuel and all of his administration charges from the carrier that he was running on, he got 62 cents per mile. This was 1998. And out of that, he had to pay for his truck payment, his maintenance, and his wages. Figure that out. Even though his truck payments were only about $2,200 a month, which is maybe a fraction of what it is today, realistically, he had to also do maintenance and his own wages. At 62 cents per mile. Back then, wages were somewhere in the vicinity of about 35 cents per mile, but he was losing money driving at that carrier. That carrier is actually quite well known. It had nothing to do with anything other than the worst contract. It actually wasn't even the worst contract, but it was a terrible, terrible contract. And that makes a big difference. You might be happy where you're driving, but realistically, are you making the amount of money for the investment that you have? Are you getting the proper return on the investment that you've made in a highway tractor? And that is not the same, because carrier contracts are definitely very different. And that's when you get paid cents per mile, or what I call lease operators. And when we do income statements and balance sheets for our clients, the income statements for lease operators are different than the income statements for the owner operators, just because they are different business models, as my article stated. So that was what my second book was all on, is comparing lease operators, lease operator contracts. When it comes to owner operators, there's probably slightly more owner operators today than there was 25 years ago, primarily because the general idea, or the general word on the street, if you are, is that you make more money running percentage than you do running cents per mile. And on the norm, that's probably right. But there are individuals who actually make worse money running percentage than they do cents per mile. And that a lot has to do with the choices that you make. Are you going to go to certain jurisdictions and regions and pick up cheap paying freight and hauling that around? Because there are some carriers that have no problem taking their 15, 20, 25, 30% off the top of cheap paying freight, because they have nothing to lose. If you're making the loss, they technically don't care. So it is your responsibility as an owner-operator to know what good-paying freight is versus what not good-paying freight. And that's what the two significantly different business models are. Well, this is the article that I wrote in March of 2024, and give you a good rundown on everything. If you have any questions about the industry, any concerns, any thoughts about your future and what you want to do as an independent operator, give me a call. We have our 800 number, 877-987-9787, and give us a call or drop me an email. Probably the best thing would be email. Because emails I generally don't lose, but phone calls can sometimes pile up so much I haven't known to lose them. I don't want to, but that sort of happens sometimes. But emails I can do more in a systematic way along that lines. Okay, other than that, I want you to have a great trip. See you next time.